119. That's where crude oil traded today. $119 a barrel, intraday, in a single session. Not a forecast, not a scenario from a bank's tail risk report. An actual print, on an actual chart, on an actual Monday in March. So before anything else, how does that happen? It happens when the Strait of Hormuz stops functioning. That's the answer. 20% of the world's oil supply moves through a stretch of water 33 kilometers wide. Today, that water is effectively closed. Iran has threatened tanker traffic. Iraq, Kuwait, the UAE, they've declared force majeure. The physical supply chain didn't bend today, it broke. This is not a spike that corrects itself by Tuesday because a rumor fades. The market structure changed today. What was priced as a risk premium last week is being repriced as a supply reality this week. And everything, every asset, every currency, every rate expectation that is denominated in dollars now has to adjust to that. The question isn't whether you saw the number. The question is whether you understand what it means. Let's be precise about what the Strait of Hormuz actually is, because critical choke point has been said so many times it's stopped meaning anything. At its narrowest, it's 33 kilometers wide. That's the physical gap between normal oil markets and a global supply crisis. Through that gap flows roughly 20% of the world's oil, every single day. Saudi Arabia, Iraq, Kuwait, the UAE, Iran itself, their exports don't have a meaningful alternative route. There is no bypass, no redundant pipeline network at scale. If the strait closes, those barrels don't reroute. They disappear. That's not a metaphor. That's infrastructure. What's happening right now is that several of those producers, Iraq, Kuwait, the UAE, have declared force majeure simultaneously, which means the supply loss isn't a projection. It's already being reported by the companies managing the contracts. The market is not pricing in the risk that supply gets disrupted. It's pricing in the reality that it already has been. The scale matters here. Estimates put the potential daily shortfall between 3 and 10 million barrels. OPEC Plus has a planned production increase coming in April, 206,000 barrels per day. That number, against this backdrop, isn't a solution. It doesn't even register as a gesture. This is the asymmetry that makes today's move rational rather than hysterical. Supply can be removed from the market in hours. A military threat, a force majeure declaration, a tanker that won't sail. Restoring that supply takes months at minimum, and that assumes the conditions that removed it are fully resolved. So when you see oil up 30% intraday, that's not panic, that's arithmetic. The harder question is how much of the current price is real shortage and how much is fear of what comes next. Goldman Sachs and JPMorgan are both putting the geopolitical risk premium at somewhere between $18 and $30 per barrel. That range is worth sitting with for a moment because it tells you something specific about what the market is actually doing. A risk premium isn't a reflection of what's happened. It's a reflection of what might happen and hasn't yet. The supply disruption that's already confirmed, the force majeure declarations, the tankers that aren't sailing, that's in the base price. The premium on top of that is the market pricing scenarios that are still unresolved. A further escalation, an extended blockade, a broader regional spillover. The market is charging admission to futures that don't exist yet. That matters because it changes the nature of the position. If you're long oil right now, you're not just long a supply shortage, you're long the continuation of uncertainty. And uncertainty has a different risk profile than scarcity. Here's what most of the coverage is missing. War premiums are structurally unstable. They exist precisely because the future is open. The moment that future starts to close, a credible ceasefire signal, a G7 statement with actual coordination behind it, a confirmed SPR release large enough to move the supply math, the premium doesn't ease, it unwinds, fast. Today's partial retracement on nothing more than SPR rumors, not announcements, is a preview of that dynamic. 15 to 20% in minutes is not an exaggeration. It's what happened in prior cycles, and the conditions for it are present right now. So the current price contains two distinct things: a real supply adjustment and a fear multiplier sitting on top of it. They look identical on a chart. They don't behave identically when conditions shift. Trading the fear multiplier as if it were the supply adjustment is how otherwise rational people find themselves on the wrong side of a $30 reversal with no warning they felt was adequate. Which brings me to a genuine question worth thinking about. Which breaks first? Hormuz reopening through some form of negotiated passage, or a coordinated SPR release large enough to actually move the supply equation? Not a rhetorical question. The answer determines whether the next major move in oil is a continuation or a flush. Drop your read in the comments. I'm curious where people are positioned on that. The levels themselves, what's actually tradable in this environment? That's the next question. The macro case for higher oil is clear. The trade is a different question. WTI support is sitting at 98 to 100. That's not an arbitrary number. It's where price held during today's intraday pullback, and it's a psychological level that the market has already tested and respected once. That matters. Support that's been touched and held on the first test carries more weight than support that exists only on a chart. Resistance is layered. 110 is the first real ceiling, the level where sellers who missed the initial move will start appearing. 120 is the upper boundary of today's range and the point where the market enters territory it hasn't sustained since 2022. Above that, the price discovery process becomes genuinely open-ended. That's not bullish or bearish on its own. It just means the historical reference points thin out. The signal most people are glossing over. Brent prompt backwardation is now above $8. That's not a technical footnote. Backwardation that steep means the physical market is short barrels right now, not in some projected future scenario, but in the actual spot market where real oil trades for real delivery. That's a structurally different condition than elevated speculative positioning. Specs can reverse overnight. Physical shortages don't. Risk management in this environment is non-negotiable. Trail stops below 96. Daily ranges exceeding 10% are not anomalies this week. They are the baseline. A position sized for normal volatility will behave like a completely different instrument in these conditions. The targets, 110, then 120 plus, are credible, but credible under a specific condition. Hormuz remains blocked, and no material SPR release hits the market. Those targets are not a forecast. They are the destination if the current trajectory holds. The moment either variable shifts, the math changes. This is not a market that rewards the set it and check back Friday approach. It rewards attention. It punishes the assumption that the thesis you held at open will still be intact by close. Oil's next move depends almost entirely on how the conflict evolves. Gold's situation today is more complicated, and in a way that most people got exactly backwards. Gold opened higher this morning. Safe haven bid, geopolitical shock, textbook response. Then it reversed and spent the rest of the session down over 1%, while oil was posting one of the largest single-day moves in years. That looks like a contradiction. It isn't. Here's the mechanism. An oil spike of this magnitude is inflationary, immediately and visibly. Inflation expectations push Treasury yields higher. Higher yields strengthen the dollar. And gold, which pays nothing and is priced in dollars, gets compressed from both sides simultaneously. The asset that competes with it gets more attractive, and the currency it's denominated in gets more expensive. Today, that macro sequence overpowered the geopolitical bid. Not permanently, but completely enough to flip a gap up open into a 1% loss. The word doing the real work there is temporarily, because the floor held. 5,000 to 5,020. That level absorbed today's selling and didn't break. That's not a coincidence of chart geometry. It reflects something structural. Central banks are currently purchasing gold at roughly 585 tons per quarter, according to JPMorgan's figures. That is continuous, price-insensitive demand. It doesn't panic. It doesn't rotate. It just buys. That kind of flow creates floors that are harder to break than they look. So there are two different things happening in gold right now, and conflating them is an analytical mistake. The short-term price action is macro-driven: dollar strength, yield moves, rate expectations. The medium-term trajectory is driven by something else entirely: an active war, oil-driven inflation that the Fed has limited room to fight, and central bank accumulation that shows no sign of slowing. Today's dip is not a signal that gold's thesis is cracking. It's the thesis being offered at a discount. Which is actually a genuine question worth asking yourself. Does a 1% drop in gold during a 10% oil surge read to you as a warning or an entry? The answer depends entirely on which time frame you're operating in, and being honest about that distinction is more useful than any price target. The targets themselves and the conditions that would have to break for the bull case to fail, that's where this goes next. JPMorgan has a $6,300 target on gold by end of 2026. Goldman, UBS, and Deutsche Bank are clustered in the $5,400 to $6,200 range. That's not a consensus built on optimism. It's a consensus built on three independent drivers that happen to be pointing in the same direction at the same time, which is rarer than it sounds. First, the geopolitical risk premium isn't going anywhere quickly. Wars don't resolve on a news cycle. The structural uncertainty introduced by an active US-Israel-Iran conflict with Hormuz in play reprices global risk for months, not days. Second, oil-driven inflation feeds directly into real asset demand. When energy costs rise this fast, money looks for stores of value that don't erode. Gold is the oldest answer to that question, and it still works. Third, central bank buying at 585 tons per quarter isn't sentiment-driven. It doesn't respond to technical levels or short-term volatility. It's a sovereign allocation decision made by institutions that are thinking in years, not weeks. That kind of demand doesn't disappear on a bad Monday. Then there's the macro environment that ties all three together. Stagflation, slowing growth combined with persistent inflation, is historically gold's most favorable condition. And the Fed is currently boxed. Oil at $100 plus makes cutting rates a dangerous move politically and economically. Frozen or rising rates in a stagflationary environment actually remove one of gold's traditional headwinds. The usual logic, rates up, gold down, breaks when inflation fear is the dominant force. Right now, it is. Near term, the test is 5,200 to 5,300. That's the level that confirms today's dip was absorption, not distribution. If that holds and breaks higher, the path toward 5,500 plus opens as a base case, not a stretch. The conditions that would break this thesis are worth naming honestly. A rapid, credible resolution to the conflict, a sharp reversal in oil that removes the inflation pressure, and a simultaneous pivot by central banks away from gold accumulation. All three reversing together. That's the scenario that breaks the bull case. Assess the probability of that yourself. The cases for oil and gold are both built now. What remains is the only question that actually matters in the next 5 trading days. What are you watching, and what does a signal actually look like when it arrives? Forget the price targets for a moment. The only thing that matters in the next 5 to 10 trading days is which of 3 variables moves first, and in which direction. Variable 1, Hormuz status. Not statements about Hormuz, not diplomatic language about freedom of navigation. Actual tanker movement, actual insurance coverage, actual cargo sailing through the strait without incident. That's the signal. Anything short of it is noise dressed as news. Variable 2. SPR coordination. A G7 meeting is not a release. A statement of intent is not a release. The only thing that materially interrupts the current supply math is a confirmed, large-scale reserve injection, numbers large enough to offset millions of barrels per day of lost output, not hundreds of thousands. Watch for the announcement that names a volume. Until then, every rumor is just a rumor, and today's price action already showed you exactly how long those last. Variable 3. Trump's posture. The current framing, that the price surge is a small price to pay, is a signal with a specific meaning. It means no diplomatic off-ramp is being prepared. If that language shifts, if the tone moves toward negotiation or off-ramp rather than justification, the war premium reprices within the session. The conditional map is straightforward. Hormuz blocked, no meaningful SPR release, Trump hawkish. $120 to $150 oil is not a tail risk, it's the direction of travel. Any single variable breaking the other way produces a sharp reversal, and on that day, gold and oil will likely move in opposite directions, not together. That's the framework. 3 variables. Watch them specifically, not generally. Which one do you think moves first? Not as a poll, as a genuine question about where you think the pressure is building. Let me know in the comments. Markets rarely tell you this plainly what they're afraid of. $100 oil and $5,000 gold, same day, same week. That's not ambiguity. That's the market stating a position about what it believes the world looks like right now. Whether it's right, you'll know within days. You now have the framework to read the answer when it arrives. One last thing. Everything in this video is for educational purposes only. It is not financial advice. Whatever you decide to do with any of this, that decision and the research behind it is yours to own.